Okay, Jeremy, welcome.
Okay.
So we're on live right now.
Okay.
So I have you. So what I've just done, just to kind of while we're giving people a chance to come on, just put up a little quick poll just to just kind of keep things moving along. So I'll give you an idea. It'll sound like it wasn't that I've kind of put up fake results, but I asked everyone, for those that already own investment properties, and the results were exactly 50-50. And I was watching it trend coming in, so it kind of switched between the two.
Really?
Yeah, but it's by the end it literally came out as 50-50, which was quite good. So I'll just put that up there. So why don't I'll kind of briefly introduce myself and then pass over to yourself. So again, good afternoon, everyone. Thank you for coming in. My name is Jeffrey Asselstein. I'm the managing director of NelsonPark Property in Qatar. And with me is Jeremy Marshall, the head of Abu Dhabi Wealth Management for IP Global. And I'll basically be your host today. Then Jeremy is going to give us lots of good, interesting content for us to learn about and to look at investment in the UK. This is, I'm sure, one of the great, if there's such a thing as great benefits from COVID, or one of the things that we're doing a lot more as individuals is getting much more used to doing either Zoom calls or webinars. So we thought this was a great chance to put our two companies together, IP Global and NelsonPark. We've been great friends for years, but this is the first time we've done a webinar together. And our plan is that this is the first of many to come. We're not going to bombard you every day, but probably every other week or so, we'll be bringing out more content to keep you interested, and that you hopefully you find that very useful. So I'll just briefly introduce myself, then I'll pass over to Jeremy to take over. So as I mentioned before, again, my name is Jeffrey. I'm the MD of NelsonPark in Qatar. We're we're a real estate brokerage, the largest independent broker in the country. We've just passed our anniversary of our 11th year in business. So we've been doing this quite a while and have a great client base, both on the landlord and tenant side, as well as buyers and sellers that we work with. So we're always looking to add value to our market and to the customers that we deal with. And this webinar series is part of that. It's really just share a few more things that we don't normally talk about, in this case, international property. So I'm going to pass this over. Jeremy, it now should be over to you in your hands, and I'll do my best to stay quiet. Everyone, if you wish, there's a chat box. I will be listening in or sort of following the chat, so I can leave Jeremy. If you have any questions at all, feel free to put the questions in, and then at the end, I'll be bringing a few questions back to Jeremy at the end. And Jeremy, thank you for putting up the slide. I should have actually mentioned at the very bottom there. Again, in our business in Qatar, we have a team of 35 agents working with all of our clients. And in Doha, we actually have two offices. One in the office I'm in right now on Selwa Road, and where we've been for a number of years is our head office. And we also have more of a retail office on the Pearl that some of you will know about. Over to you, Jeremy. Thank you.
Thanks very much. You can see the screen all right now, can you, with the slides?
Yep.
Perfect. Well, yeah, no, thanks everyone for being here. And as you can see, rather than the offices in Qatar, I come to you from my home office in Abu Dhabi at the moment. Obviously, we're on partial lockdown still in this city, but yeah, we've got offices all over the world, and here in Dubai, and our headquarters out in Hong Kong and London. So we're very much an international company. But what I wanted to do here is, first of all, is give a bit of an introduction to what we're going to do today. I'll talk a little bit about us as a company. You know, we've worked, and we're doing this whole enterprise basically with NelsonPark, really. Back off conversations I've had with Jeffrey over the last little while, and a lot of it was to do with his passion for property overall, and understanding that his loyal client base do have an interest in markets outside of Qatar as well. So as much as this is their expertise, that's why we thought a partnership was of interest, basically, so we can kind of continue to give updates really about information on markets. This isn't going to be a hard sales session or anything like that. This is talking about what we do and what markets are interesting and why people would be buying. So particularly UK seems to be the biggest topic at the moment globally, particularly because of safe haven status in times of trouble, but also particularly the stamp duty holiday they've offered at the moment. So we're going to talk a little about that, and over the long term, why the UK has always been of interest. So we'll look at importantly what kind of type of investor you are individually. A lot of you on the call today, a lot of you in different situations, different times of your life, and so forth. And so it's important to kind of realise in yourself what you probably should be looking at, not necessarily always what the most immediate thing is you might have thought about. So we're going to look at UK and London as a whole. Obviously, COVID, what the impact's been, on pricing and just generally in the industry, how people are adapting to it. Then this stamp duty holiday, what's happening with the currencies generally, the process, how we can help, and what it looks like to make a purchase in a foreign country or a UK particularly. And then a little bit about opportunities now, what it looks like, so it can make it a bit more real for you. And we will have some opportunity, I think, for Q&A at the end. So there should be a box on the right that you can write questions in. So feel free at any time. Jeff will be picking those up. And yeah, we look forward to hearing some of those. None too difficult, I hope. So yeah, IP Global, who we are. We're a company founded 15 years ago. We have transacted property in 30 different cities around the world to the tune of about $3.5 billion. UK has been our biggest market, and in that time we went into London fairly heavily from just after the GFC in about April 2009, which is pretty much exactly the month that the market seriously turned around and started being successful. But who we are and how we differ as a company effectively is we're an investment firm. We're not an agency, we're not a developer. So this is normally what exists in market. A developer buys land, will build, and then uses agencies or property companies to sell on and pays them commission. Now, we are research-led. We are different to that because we will then have our research team either based in London or Hong Kong. We're traveling around the world, going to different markets we like and meeting developers, researching the market on a macro level. And then if we like a certain pocket of a city, which we think is going to do well over the next 5-10 years or so, we will then go and buy that building from a developer. We can negotiate good rates then. But what this really means is that we offer then, as a client, anything we ever bring to market is something we have believed in enough to put our own money behind, and we have financial risk on. We're committing basically to buy everything in cash if we don't then sell on to our partners and our clients. So it allows you, the individual retail investor, to buy 1, 2, 3-bed apartment maybe in some of the more secure markets around the world, and have your hand held throughout the entire process. We have extensive track record, and we've done this a lot of times over the years, and countless schemes. So we can help with every step of the process. So this means we also have a mortgage brokerage who've got access to all the banks market you might buy into. We have the lettings team on the ground who can then find a tenant and manage that property until the day you want to sell it. And then generally, my side, the wealth advisory, the kind of just overarching, advice and support throughout the entire process. And then everything from tax, really, so you can unemotionally sit there in your offices in the Gulf region or Qatar or wherever you may be. It really doesn't matter. We have offices everywhere. And be able to buy these projects as investments and have it all managed throughout the entire process. So this slide here, this is looking a little bit about just purely our UK track record. And I don't necessarily expect you to be able to see all those different names and projects there, but you can have a look finer afterwards if you want to request the slides. But it's just to give an indication, really, and these are just some of our UK ones we've done since 2009. And this really is track record. This is completed properties which have been on market. We've rented them all out and they've performed very well, and we've seen good capital growth. So what our research team is always looking for on the very basic level, what constitutes a safe market: supply and demand imbalance, not enough property for a growing wealthy population or relatively wealthy for global standards, big regeneration, public and private money coming in, changing areas over a period of time, and that's where we'll see interest in rents and price growth, and hopefully, if we can find it, some kind of infrastructure improvements as well. So train lines, tram lines, new airports, things like that. So within the UK, we have historically done lots in London. We have, in about 5 years ago, migrated outside London as well, to go to Manchester, Birmingham, Leeds, Liverpool, Edinburgh. We've just started Glasgow in the last couple of weeks, and so there's a broad range. You know, what a good property isn't you know, a fixed thing. It kind of suits the individual. So you know, part of our advice and our conversation is to talk to you as an individual and figure out what your circumstances are. So with that in mind, what type of investor are you? It dictates some of these 5 questions really. So I think if you ask these to yourself, and you should come out really with a kind of an idea of where you sit in the you know, global pantheon of property. And what we mean by this is, you know, what's your risk appetite? Our philosophy as a company is to go to low risk, you know, long-term steady markets, basically. So, you know, you could go and find a much higher yielding properties in some of the islands in the Caribbean, or go into very far Eastern Europe or some parts of Asia. But, you know, high risk essentially is high yield in the end of the day. So, so what we really think of as risk appetite is prime locations tend to be the lowest risk, and then kind of going further out, you know, tends to slightly get higher rental yields, but that in turn will come with some kind of reasons why, you know, maybe kind of more difficult to rent, you know, more liable to have bad tenants, that kind of thing. So we're trying to find that medium balance. So what your what position is in there will dictate that. What's your timeline for a sensible property investment? We really want to be people to buying and holding in a market and believing in the market and let it do its work. So 5 years minimum, really. Gone are the days, you know, obviously I live here in UA, and lots of people were buying Dubai and trying to flip, you know, 6 months later, you know, a few years ago. And that's really an extinguished philosophy these days. That doesn't happen almost anywhere in the world. So, you know, solid, long-term stable markets, buying and holding for at least 5 years, but normally 10, sometimes more, depends on your circumstance. What your age is will dictate it. If you're close to retirement, obviously mortgages are going to be a lot more limited. So it might be more, you're more interested in higher cash flow income to support you in retirement. So actually that might dictate where you want to buy in terms of your budget and what might be a higher yielding market. So budget as well is obviously important. We'll, you know, but what I mean by this really is not to both give either overstretch or understretch yourself. So you don't want to kind of over leverage, take too much and take a risk on a property which, you know, if for some reason something happened in market and if somebody isn't rentable or something changes, then you can you know, be safe without a couple of months of backing it up. But also you don't want to go for some areas a bit too cheap, because, you know, invariably that means there's a reason for it. And particularly in the UK, my general advice would be to think of around about 135, 140,000 is probably the bottom marker where I think of as a red flag, largely because those people who want to take a mortgage, which is most of our investors, they will find it their options restricted. Banks want to lend a minimum amount largely, and so if you go below 135, you probably half your options in terms of the mortgages out there. So in general rule, we steer clear of it as a company, and I tend to you know, ask people to consider that as well. And then lastly, then what's your currency? You know, where you are in the world. If you've got a you know, earning a currency which is pegged to the dollar, you're in a very powerful position at the moment, because that's very strong against most currencies, particularly the UK, and but also against the euro and so forth. But if you owned pounds at the moment, I wouldn't necessarily expect you to buy something in America or something in Europe necessarily, where you might be losing money on currency over the long term. So have those things in mind, and this will dictate what we talk about afterwards. So UK, Brexit, I'll try and be speedy because obviously there's quite a lot to talk about, but it's important to give context to where we come from. The last 4 years has been very hugely dictated by Brexit. There's been a lot of, you know, kind of people have been very unsure of market, what's happening there. London particularly took a big hit. It is the more expensive market with lower yields, so therefore people retracted from there slightly and waited for their investments. But a lot of people also, counter to that, started to buy more in the north, where Manchester, Birmingham, the second cities, which have high yields, and it's much easier to balance your payments, rental payments, with mortgage payments there. So so just at the back end of last year, Brexit has basically been decided. It is happening. We got a majority government. It's passed through, and so consumer confidence then soared. You know, this with a long time actually, you know, low unemployment. You know, it's gone down to kind of historically low levels. The supply and demand imbalance was in favour of property. So we'd actually seen at the beginning of this year a big spike in inquiries and people buying again, and prices were starting to kind of lift quite dramatically. Of course, then obviously the COVID situation happened. We've effectively had an entire quarter of paralysis, almost nothing happening at all, but also in a strangely positive or useful way. That means that there's actually no transactions, means that there's been no distressed sales. So it's not like sometimes we've had other, financial crises or so forth, where we've had people needing to sell and get out. They actually couldn't, largely, physically you couldn't transact the sales, but also that affected consumer sentiment wasn't harmed there because you didn't see a drop in prices and people panicking or anything like that. So actually it's kind of in a strange way held market. And now with supply, obviously builders probably had about 3 months of not being able to build anything. That's held that back. So there's actually not much property coming onto market. And now we'll see with the incentives coming in, we've had a bit of a surge again of people wanting to come in, and this latent built up demand is really pushing prices again. So the last stat we can see there is in March to April, which is really the kind of the worst time of confidence, actually prices only dropped by 0.6% on a national level. But in July, we've seen a 2% growth spurt as people starting to get back to normality. In May, they allowed construction companies to get back in, and things are starting to turn to some level of normality. Why then, over the long term, UK is always considered a safe haven status. Supply and demand is one of the most important things in any property market in the world, and UK is acutely has a problem with this. In any given year, depending on whether you listen to different jurisdictions, it's either 250 or 300,000 homes tends to be the amount of property they want to build each year. But we haven't come up above 150,000 units in a single year for about 15 years. So there's a huge deficit of property in the country globally, and particularly in London, even though if you looked around, there's lots of cranes there. And so this year, with having hardly any construction going to be completed, or at least half of what was planned, this is compounding that problem. So it actually puts a lot of pressure on the market, and there's a lot of people vying for those properties that are available. So we can see there some of the stats then. If supply had grown as fast as population growth since '97, we'd have an extra 280,000 homes per year in there. So it goes to show really where the population growth versus supply has been. And actually in terms of economy, the bottom right graph, you can see there jobs have been surging in that period of time as well. Homes not so much, and population. So as a property investor, that's a hot pot and the perfect kind of situation you want to see. Here we see a graph which basically shows from about 2005 to 2020 in terms of general asset classes, things you might invest in around the world. And compared to UK property, and we can see the green line there. That's property leverage with a 70% mortgage, and the returns there compared to the grey line is Dow Jones Industrial Average. The Hang Seng Index is the one which is right at the top there. But generally what we can see there is outperformance even in times of global hardship. So the three red bars there are the global financial crisis in 2007, 2008. We've got Brexit then 2016, and it goes to show London in particular, but the UK overall, is a hugely resilient market for with international buyers helping to prop this up in times of hardship. London in particular then. It's got a GDP value of 565 billion. It's one of the two biggest financial centres in the world, that in New York, and it is a huge machine basically. So people kind of wondered if the finance capital might be, its crown might be taken by somewhere else in Europe, but I think we've got to remember context and how it compares. And the next biggest financial centre in Europe is probably Frankfurt, and that's about a tenth the size of what London is. So London's not going to change overnight, and it continues to be. There's a huge amount of corporations, but countries almost have money invested into London as an entity. So there's a lot of desire for that to keep going in the same way. And we can see even in 2018, 2019 stats here. This is a PwC graph at the bottom. The inward foreign direct investment coming into this is major capitals of Europe. Even in the Brexit times, when there was supposedly a lot of uncertainty, almost double the amount coming into London than any other city. Paris getting 12, Berlin getting 12. There's an enormous amount of money still coming into London in these times. So other than London in the UK, where might we look? The Northern Powerhouse, the government has had an initiative over the last 10 years or so to try and diversify and take some power away from just London. So the international market has been all over this, and Manchester's been booming for 5-6 years. Birmingham as well. They're probably the two secondary markets in terms of population and kind of capital power. And then after that, we've got Leeds, Liverpool, Newcastle, Sheffield, and probably in a sliding scale there, we're going down in terms of headline price, and then elevation of rental yield there. So, what we're buying in Manchester now is probably 200 to up to 350, sometimes £400,000 properties, but 5% yield. Whereas in Newcastle, we're probably going 150,000 to up to 300,000, but maybe 7% yield. So it depends on what kind of scale of risk and scale of return you're interested in buying into. Now, context then for where we are now. COVID is obviously something we all have to think about. What is it going to mean for the long-term impacts? And it's really interesting, important to kind of see as to how we compare this to the global financial crisis, what's happening now compared to then. And the huge difference really is that this is a health-driven crisis, and GFC is largely a debt. It's a credit crunch basically. So there wasn't the available credit there. So it was the banks that needed a bailout back in the day then, and these days obviously it's individual all industries essentially. So the government's been hugely more prepared for this, so that we've seen enormous stimulus packages globally, and this is to kind of help markets not fall, not compress, and to allow people to ride out the worst of it until we're back into normal way of working, and largely this is being successful. We've still not at the end of it by any means, but the extra stimulus in there should mean that what we see is absolutely recessions for this year, but a much quicker bounce back when things come to when people are getting back more into their offices and most industries can start again. We can see at the bottom there the amount of money being put in compared to GFC times to now. The UK package is 10 times what it was back then. Germany 5 times, US twice as much as it was, and this is really helpful. So what we're seeing right now in terms of process, everyone in the value chain, the supply chain for property purchase has been learning lessons. So, the lawyers, the letting agents and so forth, everyone's learning to do things slightly more remotely, just adapting basically as well. So actually, if something like this happens again, we probably won't have the same kind of paralysis as we had before. We got banks can now work remotely more. They can do approvals for mortgages remotely like they couldn't before. And lettings agencies, you'll see on Rightmove or Zoopla, the frequency of kind of virtual tours is everywhere now. So it's allowing people to be much more remote in this one. So finance, obviously this is massively important. We probably did have about a month and a half where a lot of the international banks basically pulled out of market whilst they were seeing what was going to happen. But basically everything's back now. The Bank of England cut its base rate to 0.1%, the lowest it's ever been, which means that now that kind of saving is being passed on largely to the investors. So we can expect a couple of the regular lenders, NatWest, Gibson, they've reduced their lending rates to about 3%, fixed for 2 or 3 years to start with, and that's the best it's almost ever been, for the UK, for foreign investors to get in. Lettings. Whilst obviously there was some, halt in market, now the market is kind of being strong again. A lot of people do want to move. Maybe they're sick of being locked in, their houses for a while. But also with the local market, some people waiting. It means actually there's a lot more, maybe sometimes renters than buyers. So actually there's pressure on rents to go up. So actually everything seems to be very confident there at the moment. And as we said before, the pricing wise, in Q2, basically a 1.4% fall, a lot less than anyone predicted. And since the stamp duty incentives has come in, we've seen a 2% rise in average prices across the country in the last month or so. Quickly then, how we expect this to pan out, and as I said before, we're hopefully expecting then a quick recovery, and this is the IMF's predictions here about global GDP, all the different countries around the world and how they're going to be affected and how quickly. So yes, absolutely everywhere is going to see some kind of financial impact. We had a whole quarter with basically nothing happening. It has to happen that way, but that we're expecting actually bounce backs to almost pre-COVID levels, hopefully by the end of 2021 in most cases here. So the stamp duty tax holiday, what this means. So as most of you, I imagine, probably know, The stamp duty is an acquisition tax the government takes on any purchases in the UK. There's different bandings for if you're going to be someone who lives in it themselves or whether you're an investor. Basically, if it's your first home, if you're going to live in it yourself, it's going to be completely free for stamp duty up to the value of £500,000 up to April 1st next year. So this is why a lot of people are taking advantage and they're saying, I can save anywhere between £15,000 and £30,000 on a £500,000 property if I commit to it and get it done now. So, and this is really helping the market generally. If you're an investor or a second home purchaser, you still have the 3% surplus, but you don't have the base rate. So you'd be saving still £15,000 on a £500,000 property. So absolutely nothing to be sniffed at there. And it should be mentioned, although there's lots of bodies lobbying to start it stop, that there has been, and for about a year and a half, a plan for stamp duty for second purchases to increase as of April next year, so and have an additional 2% on there. So in theory, if that still comes to pass, which we hope it won't, then actually the difference might be paying £15,000 for stamp duty now, or £40,000 for the same property compared, for a £500,000 property between now and then April next year. So it's really incentivizing people to get moving and actually commit to these purchases they've been thinking about. The other major reason, particularly people based in the Gulf region here, are buying back into Europe and into the UK, the currency. The pound's been absolutely on its knees over the last 4 years. We can see there on the right from pre-Brexit levels of 1.58 against the dollar to currently now about it's actually more like 1.29 now. But still, I mean, for the same amount of money, we're talking somewhere in $150,000, $175,000 less to buy the same value property for circa £500,000. And the bottom left here, we can see how the pound fares to the major 10 currencies around the world. So clearly the pound is a cheap time to buy, and long-term averages would expect you to make money on the currency as well. So process, how this works, what it looks like, going on a journey with us and buying a property. We are the research. We're going to underwrite and buy a project, basically commit our money to it, bring it to market. The idea is then you will buy. We'll have that consultation. We can do a pre-approval for the mortgage, so you'll be fine wherever you're based and what different banks will lend to you. We will then, most of our properties then, because they're going to be anywhere between a year and 18 months before completion, that you'll be paying a smaller deposit now, probably either 15 or 20% of the value of the property, and then nothing until it completes. So at this level with the solicitor conveyancing, this is when you'll pay it and you sign the contracts and you have then title and ownership of the property. Let's say we then wait a year before property completes. We have our lettings company who are called Complete. They're on the ground. They will then start actively marketing the properties a couple of months before it finishes, start to line up tenants. So actually very quickly we can rent out an entire building the month that it completes. And then that mortgage will draw down at the same time when it completes. So most of our buyers are going to be borrowing 65, 70% with banks there. And we can manage everything in the process there. So the Complete will be the ones who look after the tenants, be in contact with you from then on, and then you'll also have contact with our wealth management side on maybe an annual basis to talk about market, how things are going, give helps with the tax returns if you want to, and essentially everything can be covered in that period of time. So do ask if you're not sure about any of that. So yeah, where are we looking then? We aren't a UK focused company exclusively by any means. To say we've bought and sold property in 30 cities in the world in the past, including America and Australia, and it's been some of our biggest markets historically. But now we're very much focused on UK, Germany, and Portugal. And we'll talk more about Germany and Portugal at times and the different reasons why you buy there. But in the UK, we did pause. We didn't buy anything in London for the last 3 years, but we're going back fairly heavily now. We are interested. The prices come off a little bit in Brexit times. We think there's value to be had, and with the cheap finance and the currency the way it is. But we will also continue to do the secondary cities, Birmingham, as and when we find value in Manchester. Probably the very heart of Manchester might be a bit overvalued with some developers pushing pricing, but periphery, absolutely. Good story there. Leeds, Newcastle will have 2 projects launching there in the next month and a half, which will be cheaper and higher yield properties, but very strong city centre, investment stories about what kind of companies there, the breadth of investment potential, and then also a little bit of Scotland. So we've launched Glasgow in the last couple of weeks, and we've done some Edinburgh in the past. Where in London, it's not defined. We've done a lot of along the Crossrail line, which is a big train line extension going from east to west in the past, and we might still do those. We've recently picked a project in the west, which is quite rare for us. West is traditionally a more expensive areas of London, but actually after Brexit having compressed a bit, we think there's value there, so we've bought that project. But also then some pockets of value, maybe not right in the heart of the city, some areas though which can still have be super rentable, but then still have a little bit of price growth potentially to come. And then Birmingham and Glasgow ones that are coming shortly as well. There's a high-speed line that's committed and being built in the UK from London going all the way through Birmingham. We'll go up eventually to Scotland. Birmingham will be the first stop of that to be completed hopefully by kind of around 2026, 2028. And that's a massive infrastructure project that will change. But Birmingham's already been seeing a lot of inward investment there over the last few years. And Glasgow, again, third largest metropolitan region in the UK, 1.7 million population, but very cheap, 6% yields. We can get 150 to 200,000 pound properties there. So really not a big exposure to get into the UK market. Here then, as a last one, is a direct example of the London project I mentioned, just so you can see what it looks like, the kind of thing we look for. This is, certainly attractive rental property. We've taken the entire top floors, and it's an existing building of 4 floors, and the developer's got permission to build a 5th floor, which will all be 1 beds, 3-metre high ceilings, all very high glass fronted and attractive for renters there. And the property itself below has a lot of very good facilities, like it actually has a cinema inside it, but for these days, we've got a conference room so you can work from home. It's got its own gym and so forth, but actually the service charge is actually very low considering you have all these. But particularly we've picked this area, partly because of the compression in price in this area, but there's a huge amount of money being spent here in the Western Corridor. Brentford is halfway between Heathrow Airport and the city centre of London. So great access, some brilliant companies based in this area. So you have the GlaxoSmithKline, Sky, Sega, Allianz, all got their headquarters literally within a kilometre of this property. And so, and it's also nestled right between Kew, Richmond and Chiswick, which are some of the most desirable residential areas in London and the West particularly. And here we can see the property in the middle there actually looks back over 200-acre Gunnersbury Park. So nothing will ever be built there. Very rare to get those kind of views there. And prices here range from around about 370 up to about £530,000. So, 20% down now. This will complete before April next year, so we'll be in line with the stamp duty saving. But yeah, we can see here this whole town centre, a lot of money going in, £500 million coming into this pocket alone in terms of regeneration and building. And here we can see the internals of the property. You can just see the kind of tenant we're expecting here, city worker, young professionals wanting to get to the city centre easily, Knightsbridge in 15 minutes, Heathrow in 15 minutes. It is just a very rentable property, which then should see capital growth over the long term. So conclusions then. I know there's quite a lot of information to talk about there, but generally the whole how, why and where for the UK at the moment, how we can effectively handhold through that entire process and give advice on that. Why, for everything mentioned above, basically, we consider there's an overall discounted market potentially in certain pockets here. There's a lot of pent-up demand for buying in the UK at the moment. The currency is incredibly cheap and finance is historically very cheap as well. So timing-wise, if you have the liquidity to get back into this market, this is why people are going now. And where, plenty of those different locations, but this really will be down to you as an individual and what your needs are. So that will kind of require further conversation on it. But yeah, points to remember overall. COVID is a global issue. Everywhere is being affected by this, and UK has always been and will retain its safe haven status, and actually will benefit largely from everywhere having uncertainty at the moment. People want to put their money into long-term safe markets, and the philosophy for buying, hopefully it should be similar to ours, is safety is the primary focus. If you buy for the right reasons, it's about supply and demand, big regeneration areas and infrastructure improvements, and you really won't go wrong. Like the prices should always go up over time there. So thank you very much. That was a lot of information to take in one go, but yeah, we're pleased. I think Jeffrey's probably been getting some of your questions in, and yeah, let's hear some if you have them.
Great, Jeremy. Thank you very much. That was excellent. Let me give you a chance to take a breath. You've gone through a
Yeah.
lot, which is great. I'll give you a quick chance to probably to hydrate. So I'm just going to put up a quick poll. I'll give Jeremy a quick break, and I've got some questions that were sent to me separately. So I'm just going to put this poll on the screen now. Hopefully you can see it, and I'll see the results coming in. So feel free to just to click on the result if you can. Good, so it's working. I'm getting responses coming in. So really just looking to see, are you looking to invest in the future? If so, yes, in the next 6 months or in the next year, sometime in the future, or not really looking to invest. So I'll just I'll let that run for just a wee bit as we're doing this. And then, Jeremy, one of the questions that I had sent to me is, and you certainly covered it off, but I think just it's worthwhile just kind of reviewing a little bit again, is obviously, I'm going to assume, but from everyone that registered, everyone is based in the region. And, obviously we're looking at property international, and particularly in the UK. And it's not, it's best of times, we're not in that country, obviously. And now it's even a little bit more difficult to be there. So with the service that you guys provide as IP Global, I know you've covered this, but just maybe you can provide a bit more color on it. For people that are not able to travel, are they able to get access to the right people, and how can we, I guess, provide comfort that anything they're looking at can be covered off, whether it's the lettings or the management or managing a tenant in the future? How do you take care of that?
Yeah, no, good question. I mean, it's it's sometimes difficult, I think, to decide who to use on the ground as well. But I suppose everyone we've worked with, in everyone who's in the chain of the property, Liquid Experts are called our mortgage brokerage. They're probably the biggest kind of international mortgage brokerage globally, but they have access to about 40 different banks in the UK, and they're very used to the process of buying from abroad. Similarly, Complete, our lettings company, they're very familiar with the process of people buying from abroad. So there can be particular quirks, or obviously the timeline differences, silly things like that. But it's the legalities, the tax implications, things like that. So everyone we have as partners basically is not just they understand the local market; they understand foreigners buying into the local market, and lawyers as well. You find it in your everyday property law in the UK. Probably would actually come stuck with a few of the things, something as simple as certification, or proof of address, for people based in the Gulf region, and it's remarkably easily sorted. But unless you've gone through this quite a lot of times, then it can be a slower process. So largely our client base, should take comfort in the fact that from buying abroad, particularly for most of our properties are off plan. The highest risks come from off plan, let's say from financing from the developer. And part of our process when we're going to go and buy a property from a developer is to get them to open their books and show us their finances, essentially. So we want to see that they've got their bank arrangements already, they've been approved, and they have that financing there, but also they have the liquidity. So deposits being paid for the properties aren't what it takes to get the building done. And that's probably the biggest reason why anything ever is delayed and so forth. So because we're taking financial risk on ourselves, we want to make sure for our own sake, as much as our clients, that that's all in place. And also then for the contracts, we will insert clauses in there for our buyers, which aren't normally in the process, like a long stop date. So if let's say, as it can sometimes happen, there is a delay. There is a final, normally a calendar year after when they originally said they were going to complete. If they haven't done by that, the developer is officially broken contract then, and you could have your deposit back. Now, over the literally hundreds of projects we've done in our time, that's probably happened twice ever. So the fact that you do the checks of the financing and so forth early, that really does limit the risks to a very high degree.
Okay, excellent. I appreciate you covered off while you're just speaking there as well regarding tax, because obviously we're living in, again, depending on where people are coming in from, a fairly low tax or almost zero tax regimes. And then depending on the passports we carry and different things, there's a lot of things to be considered. So I appreciate you covering that. I'm just going to share the results with people online. So about 3/4 of the people responded. So half the people on the call today are looking to invest in the next 6 months. And so about 60% obviously the next year, and just a small percentage not looking to invest at this stage. So very interesting that despite what we've all been through over the last number of months, I'd say that's fairly buoyant view that people are looking, good 60% within the next year, and quite a huge chunk of that really in the next 6 months. So I find that that particularly really quite encouraging. And so really the last question I had, and then we'll kind of wrap up, is I know you spoke about the UK and the different markets. Just can you just give a really rough idea without getting into details of projects specifically, just sort of from a price level, if you look at places like Birmingham, Manchester, what sort of the starting levels of projects that are further, I guess, in the Midlands or up north compared to London, just to kind of give people a rough idea of what they'd be looking at if they wanted to invest in the UK.
Yeah, no, absolutely. I mean, of course, this will largely dictate whether you're planning to buy as a cash purchase or take a mortgage. But in terms of headline value, probably one of the cheaper ones we've launched in a while is Glasgow, which so we can normally expect prices to start probably around about £140,000. That's roughly where was about 150 where Glasgow started, but we're going to have one coming up in Leeds in the next month as well, which should start from around about 140, and that's really the kind of the lowest level we'll ever get to. And then in London, we're not the kind of, we like to kind of have bread and butter stock, which is the kind of stock which people people on the ground can buy every day as well. So we don't tend to buy the properties which are £1 million and over. Actually the biggest growth markets, the mass population that investors and locals can buy tends to be from 350 to 600,000 in London. And so these days that might end up being not even zone 2 sometimes, but even zones 3 and 4. But and that's fine. If you've got that amount of people to still want to purchase that, there's scope for growth there. So in terms of what someone would need, I tend to advise people to consider borrowing 65% if they're going to get a mortgage. There are lenders out there who will in theory lend up to 75%, but less of them. So what you don't want to do is rely on a 75% mortgage and then come to completion of property and for some reason their particular requirements don't match you. But there are definitely there are plenty of banks out there at 65%. So I'd say the wealth advisory side of what we do is huge. So it's probably reflective of your poll just now about some people not being ready and so forth, and some people are. Like I absolutely would sit down and tell people at the moment, if it's not right for you, it's not right for you. But there are great advantages for those people who can afford to do it right at the moment. But yeah, overall, I'd say, in terms of, let's say, starting figure of 140,000 to base level, if you're going to borrow 65%, and you're probably talking about, say, 5% acquisition costs in total, because you've got to consider, say, your lawyer's fees, the setup fee with the mortgage broker, the bank fee, and all, these little ones which we detail in very, very fine detail in cash flows for you in Excel sheets. You're probably then looking to need in the region minimum investment of around about 58 to 60,000 pounds, and probably because the property is going to be about a year's of build time. Half of that will come now, and half of that will come when the property is completed. And obviously, then that if you're going into London and the starting prices there are probably going to be more like 350,000, then you're going to be needing more like 150,000 pounds. We are looking actually at scheme in High Wycombe, which is kind of commutable London, so it's about half an hour on a train, but still obviously got a London story. Now that one will be about as cheap as we've had for the London story in about 8 years, so that's going to be probably from around about 210,000 up to about 350. So being able to buy a London story investment and have a 5% yield, that's quite rare. So that's about as cheap as you'll get for London. Birmingham, Manchester, similar pricing, probably from around about 200 to 400,000. Leeds, Liverpool, Newcastle, more like 150 to 250, 300,000. They're the kind of prices we'd expect to see.
That's excellent. Thank you for going through that. I'm just going to very quickly put the very last poll, and we'll take just a minute. And just kind of coming back to the last question, when about 60% of our audience today are looking to invest within the next short period of time. So just asking everybody, if you're still, those are still with us, where you're looking to invest. And I'll leave this up, kind of keep an idea on where people are at and the percent that's coming through, then I'll show you the results, just to give everyone an idea. Now, granted, we have an audience that was attracted to a webinar about the UK. No surprise that you know, a good chunk of people that are looking to invest are focusing on the UK. But I'll just give it another few seconds here for people to come through. And then,
yeah, it's absolutely, you know, if people are interested in other markets as well, like I said, we're doing Germany and Portugal and places like that as well. I mean, you know, equally, these are very safe, solid markets. So by all means, put that into the answers if you so wish, I guess. But it's and hopefully then we'll be able to run another session on those markets in the coming weeks. But also, yeah, after the event, I think we probably will have a you know, an email follow-up, and if you do want to have copies of the slides afterwards, please do reply. I don't think necessarily we ask for everyone's phone numbers there, but you know, if you want to have a conversation about this or anything, and generally how the process works, then you know, over the next week or two, we'll be open to, you know, finding time to speak to everyone individually.
That's perfect. Thank you for doing that. And so just to show you the results, again, about half for the UK, 20% in continental Europe, and then the rest in other parts of the world. So just following up on Jeremy's last bit, thank you for wrapping that up and for your time. We will be sending out a link in the next few days, which will actually have a recording of this session, so you'll have the details. And please reach back through the email. We will be reaching out to you to see if anyone has any questions at all, how we can help with our colleagues at IP Global. We'd love to help you out. And if you have just more questions, I'm just going to give you my personal view. I always like to share my personal view if I'm asked. I appreciate you. Not easy for people in the webinar to ask me, but I'll just tell you frankly, what I really like about IP Global is that they're not brokers, and this comes from a broker. So they are, they're not brokers that are just looking to sell property. They are, really doing proper fundamental investment analysis. So every project that they are marketing, they are themselves personally invested in. So they put their money, as we say back home, they put their money where the mouth is. They're invested. They're underwriting their projects. So they believe in them. And what I like is when you speak to them, they do a great job of talking through your needs, as Jeremy explained so beautifully earlier on. So thank you again, everyone. As promised, we'll wrap it up within the time that we agreed. And we'll send you a link in the coming days so you can watch a recording and share with your friends. Jeremy, anything from yourself, sir?
No, just I'd be delighted to have some conversations with the guys going forward, and yeah, I look forward to doing this again soon.
All right. Thanks again, Jeremy. I'll talk to you soon. And thank you, everyone, for joining us.
Thanks.
Bye-bye.